Welcome back to The Explainer. Today, we're going to demystify how analysts actually predict a company's financial future. Think of it like building a house. You wouldn't just start throwing up walls without a solid blueprint, right? Well, in financial forecasting, we need that exact same rigor. We're taking historical data, management guidance, and actual market realities to construct a comprehensive, logically sound model that can survive the intense scrutiny of the market.
Here's our blueprint for this explainer. We're going to look at 4 forecast approaches: top-line projections, operating expenses, capital investments, and finally, scenario analysis. Basically, we are laying the foundation, framing out the revenue, finishing the interior, putting a roof on our model, and then stress testing the whole thing against the elements.
Okay, part 1, the 4 forecast approaches. Like any good house, we need a solid foundation. And in modeling, that means choosing the right underlying approach. Pick the wrong approach for your specific company here, and, well, every single number that follows is going to be fundamentally flawed.
Take a look at this matrix. These are our core tools. We've got historical results, historical base rates, management guidance, and the analyst's discretionary forecasts. In practice, seasoned analysts rarely just pick one. They actually mix and match these depending on the specific line item they're looking at, how stable the industry is, and, frankly, how reliable the available information is.
Let's actually zoom in on the two extremes here. Relying on historical results assumes the past is precedent. It's super easy, and it's honestly great for mature, stable companies that don't swing wildly with the business cycle. But what if you're evaluating a medtech company waiting on binary clinical trial results, or modeling a totally unprecedented shift toward renewable energy? The past can't help you there. In those cases, you absolutely have to pivot to discretionary forecasting, which means building your own probability models or running your own surveys.
Moving on to part 2, framing the revenue. Once that foundation is poured, we need to project our top line. This is arguably the most critical piece of the structure, because practically every other metric in our model is going to hang off these revenue numbers. Analysts usually project revenue using 2 distinct lenses. First, you have top-down drivers. Think of this like a telescope. You're looking at the big macro picture, nominal GDP growth, total addressable market, and then figuring out what slice of that giant pie your company will realistically capture. Then you have bottom-up drivers. This is the microscope. Here you're looking at granular operational stuff, sales volumes, average selling prices, physical store counts. The best analysts, they actually use a combo of both to sniff out any hidden errors in their assumptions.
Let's look at a quick case study, a fictional company called Warehouse Club, Inc. A top-down approach here is fascinating. An analyst might forecast revenue by looking straight at the broader economy. Say they project a 3.4% growth in U.S. retail sales overall, and then assume Warehouse Club is going to capture a 2 basis point market share gain. It's a very clean, macro-driven view of where sales are heading. But flip that around. A bottom-up approach for that exact same company focuses on entirely different drivers. Forget GDP. You'd be forecasting the actual number of new stores opening this year. You'd estimate sales per store, how many new memberships they'll sell, and the exact price of that membership fee. Multiplying those operational metrics together literally builds your revenue forecast from the ground up.
All right, part 3, operating expenses and working capital. Time to fill out the interior of our house. We've projected the sales, but what does it actually cost to keep the lights on day to day? Because look, massive revenue doesn't mean much if operating expenses eat it all before it hits the bottom line.
Here is where we do a strict coherence check. Your framing and your interior must align perfectly. For example, say you project a grocery chain is going to dramatically increase its volume of perishable food. Well, perishables historically have lower gross profit margins. Your model has to reflect that. You can't just project massive volume growth in a low-margin segment without taking a hit to your overall blended profit margins. Doing that throws your whole model into jeopardy. It has to make logical sense.
So, moving deeper into the operations, how do we calculate the cash tied up in the day-to-day? We rely heavily on efficiency ratios. Think of these ratios as the vital connective tissue between the income statement we just drafted and the balance sheet we are trying to project.
By analyzing these historical efficiency ratios, we answer 3 big questions. Days sales outstanding tells us exactly how long it takes to collect cash from customers. Inventory days on hand tells us how long product just sits there on the shelf, and days payable outstanding tells us how long we can comfortably stretch our payments to suppliers.
Let's look at some actual numbers for a hypothetical company, YYLT. Notice how days sales outstanding is hovering right around 12 to 15 days? An analyst can take that historical result, carry it forward, and apply it to our newly forecasted top-line revenue. Boom! Now we can predict exactly how much cash is going to be tied up in accounts receivable next year. It perfectly links future sales directly to future operational needs.
Moving right along to Part 4, Capital Investments and Structure. Let's put a roof on this house. We need to know how much the company is investing in its long-term assets, and, crucially, exactly how they plan to fund those investments.
To build this roof properly, you have to draw a hard line between two types of spending. Maintenance capital expenditures, or CapEx, is the money spent literally just to sustain the business. You usually estimate this using historical depreciation, plus a little bump for inflation. Growth CapEx, on the other hand, is highly discretionary. That's the money spent to actually expand, like building a multi-million-dollar manufacturing facility.
And guess what? Time for another coherence check. Honestly, this is where a lot of rookie models completely fall apart. If you forecast massive growth CapEx, say a giant new roof for the company, your model must realistically explain how they are going to pay for it. Are they issuing new stock? Piling on massive debt? Your capital structure forecast has to align perfectly with your investment assumptions.
To figure out that funding mix, analysts turn to leverage ratios. Metrics like gross debt to EBITDA, combined with management's own stated target guidance, help us forecast the ultimate capital structure. This tells us the exact mix of debt and equity the company is going to use to fund its future.
Which brings us to Part 5, Scenario Analysis. The house is built, foundation is set, framing is up, interior is done, roof is on. But before we finish, we have to stress test this building for severe weather.
Look, the future is inherently uncertain, right? Relying on a single, rigid point estimate is incredibly fragile. That's why we develop multiple forecast scenarios. You absolutely need your base case, sure, but you also need a bull case for sunny weather and a heavy bear case for when the storm hits.
We build out these scenarios by looking at unavoidable risk factors. Every single company faces these. You've got cyclical economic swings, fierce new competitors entering the market, raw inflation squeezing your input costs, and perhaps most dangerously, rapid technological developments.
Speaking of tech, we really lean on Clayton Christensen's pioneering work here regarding disruption. He split it into two buckets. Sustaining innovations are marginal, like adding digital recording to existing cable TV. But disruptive innovations, those are entirely new value propositions. Think about how streaming video completely destroyed the seemingly invincible cable TV market. Blockbuster famously passed on buying Netflix for just $50 million back in 2000. If your forecast model relied purely on historical growth rates during that industry shift, your entire financial house would have vaporized.
Which forces us to ask a critical final question to leave you with. When standard historical base rates completely fail, and past performance is absolutely no guarantee of future results, how will you use discretionary forecasts to model the survival of a company standing on the brink of total technological disruption? It is the ultimate test of a financial model, and frankly, the ultimate test of an analyst. Keep building those models with coherence and rigor. Thanks so much for joining me on this explainer.